And with us, Mohamed El-Erian. Mohamed, we see new weakness in the euro, $1.25.54. Matt, the camera guy, get over here. Here's the euro, and you can see, folks, the slope has changed so much. Mohamed, an acceleration in euro weakness. Do you have any idea where euro weakness stops?
It stops when the market is convinced that Europe has a sustainable solution, that Europe is dealing with its debt overhang, and that the good isn't being contaminated by the bad. What you get right now is a notion that the countries that are facing most difficulties are able to finance themselves on the back of the strong countries. And the result of that is that people are stepping back from the euro and are stepping back from government bonds issued by these weaker countries.
We see unrest in Thailand today. We saw a lesser unrest in Germany over the weekend where the people speak. Can the elites, the people you meet with every day in Europe and everywhere else, Mohamed, can the elites convince the people to take these measures? They certainly didn't do that in Westphalia over the weekend, did they?
Not as yet, and that speaks to something very important, which is that the politics of austerity, Tom, are very difficult, as are the politics of bailout. And in Europe right now, you have both the politics of austerity and the politics of bailout. And voters are saying, hey, wait a minute, I don't like what I'm seeing.
Well, you look at this. I'm going to steal that phrase from you, Mohamed. Politics of austerity.
Actually, it comes from Greg Ip.
Okay, well, I'll steal anything from Greg Ip, the Economist, any time of day. He's very good. And the Greek spread here, Matt, the camera guy, get in here. Here's the Greek spread. I mean, the fact is, Mohamed, things are improving, folks. The spread, of course, blew out here a few weeks ago. The 10-year Greek to German was 9 full percentage points. And you know, Mohamed, good news. We're at 439 beeps. Not bad, really coming in nicely. Can you signal all clear when you look at the spread market?
Not as yet, because we're there not because the fundamentals have improved, but because we've had the shock and awe from the ECB. In particular, the ECB has been in the markets buying Greek debt. The result of that is, of course, that you raise the price. The question that everybody has to ask is the following. Is the ECB's presence permanent? Are they willing to contaminate their balance sheet buying Greek bonds? Or is this like an FX intervention where they come in, they see if it works, and then they step back and analyze?
Well, critically, Hans-Günther Rediger at BNP Paribas suggested that President Trichet was quite upset Sunday evening and explained the fragility of the European banks. Within your intelligence, with your large team at PIMCO, how fragile are the European commercial banks?
Our sense is that they are quite exposed to peripheral credits, and part of the response about this weekend had to do more with the banks than with Greece, buying time to allow the banks to recapitalize. If you want a historical example, it is going back to the 80s when the American banks were very exposed to Latin America, and the system looked for time. We also learned something else in the 80s, which is that debt overhangs matter. That when you have a debt overhang and everybody knows it, and they know it in Greece, you don't get investment, you don't get growth, and ultimately you have to deal with the debt.